Good morning, ladies and gentlemen. This is Clueless Trading Frank. Welcome back from a hopefully a very enjoyable and restful Labor Day weekend, long weekend, to a lot of dramatic events that have taken place over the last 72 hours. Today is September 5th, 2017, approximately 8:25 a.m. pre-market U.S. market opening. Futures are down approximately 5.5 points. And a reasonably sharp recovery from the lows that we saw on the third, um, which was Sunday, after the North Korean announcement that they might have detonated a underground nuclear bomb, and according to the North Korean government military officials, possibly a hydrogen bomb. Now, on the surface, these things are very dramatic news. We would think that the markets would be down 100 on the Dow Jones on the futures and 15 or 20 on the S&P 500. But as you all know by now, it's not what we think or what we know. It is what the reaction to these global macro events are, and in this particular case, obviously quite a negative event. So we rely on tactical charts. We rely on what we see on our forecast based on all the different technicals that are in front of us. That is exactly what you're seeing in front of you right now. These are the S&P E-mini futures, which are showing a slight fall of roughly 6 points. Saying all that, let me get straight into this so you guys are all prepared what might be coming. Remember, we cannot game volatility. We can only structure it. We can see what the downside is. We can see what the upside is. And the biggest strength that Clueless Day Trading is that we structure the levels so that traders, members, traders, investors are prepared what might be coming their way. Trading and investing, as I've always said, is a game of probability. So you quantify your risk up and down, and then you manage your trades accordingly. This is not a game of certainty. Saying all that, global markets seem to be steady after the initial fallout. China is up on certain exchanges, and Japan is down. They're the closest neighbor to North Korea, obviously. The Kospi is down slightly. That's a South Korean index. European markets seem to be doing okay. German index is up. The DAX, the FTSE, which is your British financial market, the UK Financial Times index is down slightly. Oil is up sharply. And as I've told you, U.S. markets are sitting here at around 2468.50, down 5.75 points. Here is what I see on the technicals, and here is how we need to prepare myself. Before I go any further, keep in mind, we are entering a phase of extreme structured volatility. There is no question about it. So even if prices are ramping and traders are prone to chasing prices without truly looking at the technicals and looking at all the tactical charts that can be posted all through the day, you have to remain extremely aware that things can change very quickly. We live in a world of algo HFT, that's algorithmic high frequency trading domination, and sudden sell programs and buy programs can affect your mental ability to manage your trades. In order to minimize your emotional aspect or your emotional quotient of your trading, which generally is wrong, in all our cases, you have to rely heavily on tactical charts and manage your trades accordingly. So far, so good. Let's move on. At this point, this is what I see in front of us. This was the original missile launch, a North Korean missile launch. This was the lows back at 24.21, which was a buy event. We capitalized on that in a large way. We capitalized on the VIX moving up approximately 400% on the hedges. Long positions were added here. They were average cost down here, and you can certainly see that the end of the month rally, the window dressing rally, or whatever you call it, the portfolio markups took the markets up substantially higher. Many of our members, many of them, profited tremendously. However, we're not in the business of just BTFD or buying the you-know-what dip. We're in the business of seeing what would be a quantifiable risk measure to get into it. That is exactly what I'm going to explain over the next couple of minutes. So please review this video cast before you start your trading week. So at this point in time, we have we had a powerful acceleration channel, which ended on the last day of the month and continued through on Friday. You can see that. We had a drop on Friday, approximately around 1 p.m., and you can see that move down here, a minor one. Here comes the North Korean announcement of a nuclear test, and we fall pretty sharply all the way down from the highs of 2480 or so on the E-minis down to 2460. Generally, SPX handles, S&P handles, whether it be on the futures or the regular S&P, move in increments of 10 or 20 points. Well, this was 2480, this was 2460. It also came close to closing a gap, which is not being seen here, but there was a gap on other charts that we detected. At this point in time, we have had a recovery from the 2460 level or so to a high of approximately 2480 at around 7 p.m. last night. We are still moving within this channel, which is flagged as a bear flag. This is what a bear flag generally looks like. Now, whether the bear flag moves up, let me get the pen, whether the bear flag breaks out is determined by levels, and that level is approximately around 2471, 2472. If we break out of this range, that bear flag is roughly around 2473, right up here. If we break out of this range, we'll be able to close the gap. You can see the gap here. Remember, this is the gap, and we will move up and test the highs and possibly break out over 2480 and print and test the all-time highs on the S&P 500. That would be a very bullish event. In lieu of that, this still remains at this point a bear flag, unless the bear flag, as I stated, is negated over the 2473 level, in which case we'd be closing the gap and moving higher. Again, repeating the same thing. If we break below, we will test the lows of 2460, which is a very likely possibility, and that would be the impulse bottom on the news of the nuclear test out of North Korea. If that holds, and if it is going to be a bullish event, then we are going to create a dragon bullish formation such as this, a W formation. We don't know yet. That's the reason why we track charts. That's the reason why we are tactical traders and tend to far outperform the markets than other services and other emotional traders that simply chase prices. And I keep on repeating that because I want the mental calibration to set in deep with all my members who are involved with Clueless 8 trading. And many who have seen the rewards of their keen robotic nature of looking at my charts. So at this point, this is still a bear flag, and if we break below this, there could be a sharp pullback towards the 2460 level. Keep in mind, we will be getting tons of news flashes coming out of Washington, D.C. Congress has returned for business with 12 days to pass the debt ceiling, which in my opinion will get passed. There's no question about it. I believe the markets are relying on that. The Houston recovery efforts is going to cost billions, $100 plus billion. We have Hurricane Irma barreling through towards Florida, which is probably going to move up the coast towards New York, in my area, New York, New Jersey. And that is also going to be cause for further government spending on the rebuilding side. Hopefully it won't be as devastating as it was in Houston with Hurricane Harvey. Whichever the case, markets are all considering that. And that's the reason, one of the reasons why the belief that government is going to continue to push money into the U.S. economy, which would be a big catalyst for further spending, which means the GDP keeps on growing, which means all kinds of stimulative effort, is a positive catalyst for the markets despite the natural disasters. So saying all that, one last look at this chart. All levels are cleanly put. This was the big breakout level. You could see that. We certainly took advantage of that. A nice cup, a handle, and a big breakout, retest of the breakout level, and a continuation pattern. Upper end of this ranges go all the way up to 2490 plus. That means S&P X 2500 plus, retest of the all-time highs and possibly a little bit higher. Longer term charts are showing approximately 2550 or so on the mid-range on the SPX. At this point, the bear flag is intact. Breakout over, let's call it 2474 or 2473 would negate the bear flag. That's a positive. Breakdown below would bring us down about 100 to 120 Dow points. Break below that, we're going to retest this big breakout level again, which is 2454. Lower end of this consolidation channel or handle on the cup is 2444. I'll be guiding people through all this in the form of my tactical charts, and you certainly are more than welcome to take advantage and benefit from that. This is where we stand right now on this particular screen. Futures still remain down approximately 5.5 points. Let's move on. Let's take a look at this large macro pattern completion picture that has served us extremely well over the past couple of months, if not the past couple of weeks. Things have happened quite dramatically. And when so much money gets back into the market, or in the form of a short squeeze, individual retail money is still on the outflow mode. As I've mentioned before, when you have $30 billion coming out of the market over a 4-month period, you got to bet that a lot of the sellers are out and the markets would go higher. That's exactly what it did. Okay? So when you have most of the retail sellers out of the market and the majority of traders and mom and pop bearish, then you get these type of moves. Because honestly, there is no euphoria in the market. Technicals are a totally different story. You can get overbought, oversold in a matter of hours, if not a day or so, and that's a different story. So let's take a look at this. We have had large drops for different reasons, political reasons, overseas North Korea concerns. That was another cup, that was another handle, a breakout, retest of the handle, get back into a trading range. The North Korean Japan missile launch fallout. As you can see, it's extremely algorithmic. Markets are not linear. They don't go up in a straight line. They don't go down in a straight line. They do mathematical moves. That's the reason. That's because black boxes or supercomputers, which are programmed by people in many cases who have no idea about stock markets, but in most cases are trading off different algorithmic levels, trend movements, momentum channels, things like that. And those are what are detected on my charts. Practice makes perfect. And you have to have a deep understanding of what's happening with the fundamental nature of the markets, both on Wall Street and overseas. That is what we deliver here at Clueless A Trading. Saying all that, this is what happened. There was a rising wedge. Guess what? Rising wedges consolidate. Well, for whatever reason, they did. In this case, the nuclear test. Now we are moving within a band. That band is approximately 2472, low end of the band, which is the lower end of this trading channel. Okay, is 2460. Break 2460, you're going to test this downtrend line. You break that downtrend line, you're going to test this downtrend line. That's 2447 or so. Whichever the case, this is where we stand. That's the bigger picture of what is happening out there. This, you can certainly see, again, is a bear flag. And that bear flag most probably comes down, test this level. That would be a higher technical probability. A breakout, certainly possible. Right over that gap, we're going to go, and there's going to be a powerful short squeeze, and we're going to ramp higher. So internals are going to move very quickly. This is the fast stochastics, 1412, and these are going to reset and up and down very, very quickly. I like looking at the slow stochastics too, and that's shown quite clearly on my Algo HFT platform quad that I post, and I will be posting pre-market. So that's where we are right now. Let's take a look at, there's one other thing that I detected that I want to share with people, and that's the fact that this Bollinger, instead of creating a upper type of pinched Bollinger, now has created a lower pinched Bollinger. You can see that. So that's mildly bearish. I'll be showing the Darvas box tonight, and the Darvas box, instead of going like this, now is like this. Does it mean it's the end of the world? Absolutely not. It simply means on a short-term basis, there's pressure on the markets. So don't get too excited about prices just because something's up $3, $4. You can certainly trade it. Active traders like us, we trade them. But don't go, date them. Don't marry them at this point when it comes to high momentum trading with the stocks like Amazon, Netflix, Apple, I believe to be more of a swing trade, Alibaba, Facebook, Tesla. Date them. Don't marry them. All right? Keep position sizes reasonably small. Be active. If you can't be active because of your work commitments during the day, then don't bother. Just, sit back or put some nice setups depending on what I put out there or your own gut feeling on certain things. Let's move on. This is your picture of the S&P 500 pre North Korea. Let me try to pull this in. That's better. Okay. Pre-North Korea nuke test, and it's very bullish. All right, no question about it. This is your weekly chart, and you can see here, this was the February lows, this was the November hit, and then the February lows, and November 2016 we're talking about. That was right there actually, and then you can see what's going on. Consolidation channels, big breakouts. That's the nature of the face of a powerful bull. At this point, again, another consolidation channel, nice fat breakout. And if the North Korean incident had happened, we'd be opening up over 2,500 or close to it. However, we always have hedges. A small portion of your portfolio need to be in hedges. And those hedges are going to work out very nicely today in the form of those cheap fixed calls, which were approximately around 20-some cents. Last I checked, they were around 40 cents, and at one point they were higher when futures were lower over the weekend. Thinkorswim tabulates the estimated value, and you can certainly see that on your own P&L on your side if you're using Thinkorswim. So this was certainly bullish going into the weekend, and now has pulled back a bit. Not much, just a bit. I don't think this pattern's broken. This pattern will be broken below, on the swing basis, 24.29. That's a 20-day moving average. We break that, we're going to touch below 2400. All kinds of panic talk are going to be out there. But as long as these lines, which are the roadmaps, are the highways that the market travels in, the 20-day moving average, the 34-day moving average, the 50-day moving average, are still inclined and curved, and the trajectory is still going higher, the markets will continue to go higher. Stochastic's good, nice bounce, all that. We'll see how this picture changes and the market opens very shortly. Now, let's take a look at, now these things are very critical because if you're a trader, you need to manage your trades by reviewing my all these tactical charts that I put out there. Otherwise, you're going to be caught in another trade and you don't know what the heck's going on. Here are your E-minis, and let's see what's going on the hourly. This is the ultimate trading roadmap. This is where we are. And even though this is a minor bull flag formation, when you look at the levels, we're still there. We're still holding nice. Now keep in mind, right there, if you can see, I'm sure you can. Let me change the color. Right there is a negative formation on the 1 hour. This is the 1 hour chart. Doesn't mean it's 1 hour. It simply means that, it's showing the candles on a 1 hour basis. This goes back all the way a couple of weeks from the previous highs. We have a crossover. That's a 3450 crossover. Advanced coaching session students all know this has to be monitored. Once you have this type of crossover, the market can still go higher. There was a bear flag, but then it dropped again. There's no guarantees that's going to happen. However, this has to be taken into account. This is a bear flag. There's a crossover. We have major global tensions. We have domestic politics in play for the next 10 days. You're going to see short squeeze moves and things like that, but you know what I'm saying. People who don't understand some of the things that I'm talking about, both technical and fundamental, like I've always said, sign up for the ACS Advanced Coaching Sessions and you know what the heck is going on. You won't be able to control it, but you'll be able to certainly control your trades a heck of a lot better than you ever did. That was a little bounce. People got excited. That was a bear flag. And this came. Markets have a funny way of getting towards levels they want to go before the news hits. It's called technicals precedes fundamentals. So at this point, if this is broken out, we go over 2480 or 2474 or 2473.06 at this point. This is the E-minis, and this is a Fibonacci retracement. That means we're going to go higher. Go below this, we're going to bounce here, or we're going to fall. We break this downtrend line here, which is approximately at around, I would say, 24, slightly shy of 2460, 2458, and the 50 moving average, 150 SMA, simple moving average at 2455. Gentlemen, we're going to fall pretty sharply. Hedges are always important, always being short. On that note, have a great day. Thank you for all your support at Clueless A Trading. God bless you all, and welcome back.